Good morning, good afternoon, good evening. This is the Silver Stacking Dad coming back at you today, and we are going to talk about some big news. Seems like the Federal Reserve is upping expectations on their timeline on interest rate hikes. Uh, you know, it's been sitting at 0% for quite some time, and today was big talks about upping that considerably a lot sooner than expected. So, also during the time at which we're seeing some of the highest inflation percentage rates ever. So, this is some big news and some not so great news for all the lower class individuals here who are struggling to get by. So we're just going to go over a little bit of this today. It says the Fed moves up its timeline for rate hikes as inflation rises. The Federal Reserve on Wednesday considerably raised its expectation for inflation this year and brought forward the time frame on when it will next raise interest rates. It says, however, the central bank gave no indication as to when it will begin cutting back on its aggressive bond buying program. Though Fed Chairman Jerome Powell acknowledged that officials discussed the issue at the meeting. So yeah, they're not going to taper off buying those bonds at all. Not at all. But let's see here. It says, though the Fed raised its headline inflation expectation to 3.4%, a full percentage point higher than March's projection. So yeah, it's flying up there. The biggest thing I wanted to show is they even admit to it. It says Powell did note that some of the dynamics associated with the reopening are raising the possibility that inflation could turn out to be higher and more persistent than we anticipate. Duh. Really big duh there, guys. Alright, so we go over here, and this caught my eye too. It says Fed meeting surprise. The central bank left interest rates and bond buying unchanged, as I mentioned a moment ago. Then it says right here that in his post meeting press conference still sees current price pressures as transitory. It's not transitory, guys. This is just going to keep going up. But conceded inflation could be higher and more persistent. So he's saying it's transitory, but it's going to go higher and be more persistent than previously expected. Such bull. The Federal Reserve now expects its most watched core inflation gauge to rise 3% in 2021 versus March's 2.2% projection. It's going to probably go higher than 3%. But let's see here. So, yeah, it says that discussed if enough progress has been made to begin tapering asset purchases, but he said that substantial economic progress, seen as a code word that the Fed is ready for taper talk, remains a ways off. But this was the talking about meeting, he said. That's ridiculous. We come over here, we look at inflation rates. This is the annual inflation rates by month and year for 2021, 12-month based back in 2020. Look at this, guys. From 1.4 to 5. 5, guys. Look at that. I mean, it's just trended right here back up to 5. I mean, if you look over these years, look all the way down to 2000. The only time we've been at 5 is 2008. We went to 5.6, 5.4, 4.9, and then trended back down. I don't see us trending back down. I really don't. I mean, we could, I suppose. Like, they got it really low there, but I don't know. I really don't. but I don't expect it to. I expect it to go much higher. 7, 8. Oh, I don't even want to talk about it. It just disgusts me and makes me worried. But then you wonder, how much of the Federal Reserve percentages are they going to raise interest here? It says this was from yesterday. Yeah, of course now. Federal Reserve officials signaled on Wednesday that they expected to raise interest rates from rock bottom sooner than they had previously forecasted, that they were taking baby steps towards reducing their vast bond purchases. They're not taking no baby steps. Tweaks that together demonstrated their increasing confidence that the economy would rebound robustly from the pandemic. There's no rebound at all. We are not rebounding. I guess if you're Amazon, Walmart, you're doing better than ever. Fed policymakers expect to make 2 interest rate increases by the end of 2023. Them saying this has just crashed and bottomed a lot of stocks. And of course, others have gone up. The central bank's updated summary of economic projections. It says anticipated rates would stay near zero right now, where they have been since March of 2020, and to at least 2024. Officials now, see, they said originally it was going to last all the way to 2024, and that they're going to keep these to 0%. Now officials see rates rising to 0.6% by the end of 2023, up from 0.1%. That doesn't seem like it's a lot, but that is huge in the market there. That can cause a lot of ripple effect, especially when we have increased inflation going at the same time. So you wonder, how do interest rates affect things? What happens when interest rate rise? When the Federal Reserve acts to increase the discount rate, it immediately elevates short-term borrowing costs for financial institutions. This has a ripple effect on virtually all other borrowing costs for companies and consumers in an economy, because costs financial institutions more to borrow money. These same financial institutions often increase the rates they charge their customers to borrow money. So, individual consumers are impacted through increases to their credit card and mortgage interest rates. So we're already in a hyper bubble for housing, and they're going to raise the interest rates, especially if these loans carry a variable interest rate. When the interest rate for credit cards and mortgages increase, the amount of money that consumers can spend decreases. So consumers still have to pay their bills. When those bills become more expensive, households are left with less disposable income. When consumers have less spending money, business revenues and profits decrease. So not only do you have hyperinflation coming, but then you have people not being able to pay for their services. So an increased cost while interest rates are going up higher. So as you can see, as rates rise, businesses are not only impacted by higher borrowing costs, but they are also exposed to the adverse effect of flagging consumer demand. Both these factors can weigh on earnings and stock prices. Doesn't sound good, guys, not at all. And the market showed it today. So yeah, buy more silver, buy more precious metals, prepare. That's all I have to say, because I don't see these coming up months or even the next year or two being good at all. You see the drop right there, just from the news. We were steadily, going up, and then boom, boom, and then we rebound, and we're steadily back again. So it's like we will never hit the 28 mark, but that's fine with me. I'll have more time to buy more silver at reduced prices. So I just want to go over that information today. Big news, guys. If you seem to miss it, they're saying they're going to raise that interest rate a lot sooner than expected. And while inflation is going up, I mean, these charts show it right there. So thanks again, guys, for tuning in. Silver Stacking Dad is out.